I got to ask you what you make of this back and forth.
Well, it's good to be with you, David. Look, I think that the tension over trade right now is a matter of grave concern. I think that the challenges facing the U.S. economy are not principally right now coming from trade. A lot of the issues that are being addressed through the trade war are actually going to hurt the U.S. economy. You take the steel and aluminum tariffs, downstream, that is going to hurt car manufacturers. It's going to hurt aluminum can manufacturers. It's going to drive up prices in the United States. With the tit-for-tat imposition of tariffs, it's going to close markets to U.S. exports. The combination of higher prices in the U.S. and fewer exports is not a good thing in the economy. It also comes at a time in the U.S. economy when the Federal Reserve is looking at how far to move and how fast to move on interest rates. A lot of the implications of the trade war are going to show up in prices, higher prices. That's going to send a signal that perhaps they need to move faster, perhaps they need to move farther. At the same time, the trade war is going to slow the economy. That's a very confusing set of signals. The risk of miscalculation in reading those signals is great. I thought it was interesting when the minutes of the Fed meeting came out. They will always be careful not to attribute any policy they make in monetary policy to a specific fiscal policy or trade policy. But they have to look at the data. They have to look at what are the macroeconomic implications. And this is going to be a very confusing time for the Fed.
Even if these things are seen, and there's a part of the market that sees it as negotiating positions. Yes, they hurt the U.S. economy, but at some point, maybe Donald Trump gets what he does and he pulls back.
Look, I think it depends what you view as being the principal U.S. concerns with China. I don't think the trade deficit alone is the concern. I think the concern is, are there markets open to U.S. exports? Are there markets open to U.S. investment in China? Are they protecting intellectual property, or are they demanding that companies hand over intellectual property in order to do business in China? Those are the kinds of structural issues that should be the subject of bilateral discussions. I think that this trade war is a distraction in many ways. Clearly, there are challenges in the U.S.-China relationship. I devoted an awful lot of time to negotiating these issues with my Chinese counterparts. We made progress. We made progress in terms of exchange rate management. We even made progress on steel and aluminum, where at the G20 meetings in 2016, there was an agreement to have a G20 process that China was part of to reduce excess capacity and to monitor it. I think that if you continue to bring the world together and put pressure on China to do the right thing, it will be more effective than using a kind of spurious claim of national security to level a tariff that's not just applying to China, it's applying to Canada and to Europe and the closest allies of the United States. It doesn't make sense.
I was going to ask you about CFIUS and the use of that as a tool, of course, to level a heightened, I guess, level of scrutiny towards Chinese investment. Do you think the United States is shooting itself in the foot here by cutting off perhaps what would be a key source of financing from the Chinese into its tech sector?
You know, from the very beginning of the United States, we've been an open market for foreign investment, and it's been one of the ways the United States has grown for a very long time. At the same time, there are real national security concerns that CFIUS was designed to provide a tool to deal with. If it becomes a tool of just economic, closing your market to economic investment that does not have national security implications, that's a different matter. I don't think that would be good for the U.S. economy. Now, I don't know that that's happened yet. I think that there's been some care taken not to step over the line, but there's legislation pending. There's a lot of rhetoric. I don't think it would be. We complain quite a bit that the Chinese market is closed to U.S. investment. There actually has been a move in the last year to say that in the financial sector you can have 51% ownership of a financial firm by a foreign investor. Making progress on opening markets is something we thought was important. I hope that CFIUS remains a national security tool. And in that context, I would continue to defend it.
I had to ask you this question. Obviously, one of the other angles to this spat between the Chinese and the U.S. is possibly using some of the tools that are seen as perhaps Beijing having here. Whether it's the currency or the treasury or the amount of treasuries they actually hold. But when you were head of the Treasury, did you ever think about that at some point it might come back and China might use that mountain of debt it holds as leverage against the U.S.?
You know, I spent a lot of time when I was at Treasury worrying about whether the RMB was being allowed to float up when market pressures were driving it up. I think we made considerable progress when China agreed to have the RMB pegged more closely to the market, and when they actually took steps to allow the RMB to appreciate. My last year and the year after that, China spent over $1 trillion of its reserves defending the RMB to keep the value from dropping. Now, their principal objective was probably to limit capital flight. They didn't want the money just leaving China. But it had the effect of allowing the currency to do what we had said it should do for a long time, which was appreciate to reflect the inherent strength of China's economy. Now, I think it's interesting. There have been 2 currency reports so far in the Trump administration, and neither one has deviated from where I was, which was to say that there had been progress. They went back historically to criticize past practices, which, you know, are easy to criticize because there was a long period of time when the RMB was being kept down. Now, I think it's good for China to have the RMB start to reflect the strength of China's economy. It gives more purchasing power to Chinese consumers. It helps grow the domestic consumer sector of the economy, which is so important to maintaining stable growth. But it also makes it more competitive when you're comparing a Chinese product to a product that's produced in the United States or Western Europe. So I think it reduces tension. I'm not going to say there aren't problems. I think there are serious challenges that have to be engaged. The United States has to engage China. Unfortunately, when I look at the engagement today, just today, you know, the visit in Europe of Premier Li Keqiang with Chancellor Merkel, it looks like the rest of the world getting together to say we still believe in the rules of norms that the United States designed, and the United States appears to be the outlier. That's not good. That's what worries me. I'm not worried when the United States challenges China on legitimate grounds. I was as aggressive challenging China as any of my predecessors were. What I think is wrong is that the United States loses its very special role as the leader of speaking for international norms, and that's what I worry about now.
What would you be pushing China on specifically then? If you had to change the prescription right now, what exactly would
Look, I think China's economy needs to be more open to market forces. You know, the subsidies that still flow through the economy, you know, support heavy industry and state-owned enterprises. It is going to help in the development of new ventures in terms of empowering consumers to let market forces be more powerful. I think foreign investment ought to be on par with other major economies. It's the second largest economy in the world. It should be more open to foreign investment. And on intellectual property, it's very important to have the internationally accepted norms just become a norm in China. There's been progress there, and I think that progress contributes to the development of indigenous innovation in China. But there's still a ways to go. And the fact that when U.S. companies come to China to do business, they have to, you know, hand over intellectual property is a problem, and that ought to change.
I have to ask you about what's happening in the markets as well, just to pivot to that conversation here. The flattening yield curve, that's probably one of the most talked about topics in markets this year. I mean, when you were head of the Treasury, the 2-year yield averaged 0.5%. Let's call it even 0. The 30-year is about where it was back then, so it's a much flatter curve. Did you look at that, or are you looking at this right now, and does it make you worried that it is, in fact, predicting a slowdown to come?
So, look, I think historically the yield curve has been a very stable predictor. You know, it has accurately predicted almost every downturn, and I don't believe, had more than one false positive in terms of predicting a recession when there wasn't one. So if you saw an inverted yield curve, I think you'd see people getting quite nervous now. We're at a moment when, because of changing policies, there's going to be stress on spreads. And it may not be a normal time in terms of the yield curve being the leading indicator, but I do think it warrants careful attention. It doesn't show a lot of confidence in the long term when you don't see long-term rates starting to creep up, when short-term rates are being forced up by changes in monetary policy. I think that there's a lot of reasons to be nervous about the economy. You know, obviously, we're in the 9th year of a recovery, and we're probably going to break a record and have the longest.
It's actually one of the longest.
Yeah. Look, I'm proud the first 7 years of it were on our watch. So we did a lot to drive this recovery. And I hope it goes on. I don't see any reason that it has to be stopped in its tracks. I look at the policies that are being put in place, and they're not friendly to continuing a long-term growth period.
Such as what?
So I think the trade policies they're causing uncertainty that's going to be reflected in investment decisions, and it's going to put a drag on the economy in terms of higher prices and less open markets. I think the tax policies, which while they were cheered by the business community, it's a little bit like pouring kerosene on a fire. There's a flare, you know, when you pour the kerosene, and then it burns off. The after effect of the tax cut will be trillions of dollars of debt. Trillions of dollars of debt. And I think that's going to be a burden on the economy as we're getting to the end of the economic cycle. I worry if we had an economic downturn that we don't have the fiscal arsenal that we should have to respond. You would want the federal government to be able to jump in and put, like we did in 2008, 9, and 10, put a lot of fiscal measures into the economy to get it going. When we're adding literally $2 trillion to the debt over the next 10 years, it's going to put a lot of stress. So I think it's going to be a problem driving interest rates up. It's going to have a drag effect on the economy. And then in the downturn, it's going to be harder to respond. That all worries me.
As it pertains to the bond markets, and speaking of trillions of dollars of cash that's needed, some are predicting $1 trillion of potential issuances or auctions from the Treasury this year. This time around, though, not like your time, the Fed's not a willing buyer anymore. Do you think there's enough appetite, even capacity for the market to absorb all this debt coming?
Yeah, my sense is that the demand for U.S. debt will remain very strong. It remains the safest investment because the economy is picked up, because our interest rates are higher. It's an attractive interest rate. I think what you will see is perhaps higher interest rates because of the amount of borrowing, that's being required. You know, it's supply and demand. I mean, if we were borrowing less, we'd end up paying less.
Does the shape of the yield curve, I'm curious, does the shape of the yield curve affect the debt schedule and the types of dated securities that you do? Are you looking at more longer dated because borrowing costs at that end of the curve are lower? How does that factor into the thinking of, say, the current staff there?
I can tell you what the traditional way of thinking of it is. I'm not sure I can speak with authority about what the current discussion is. You know, there is a very high premium on predictability. Steady, regular issuances that are expected by the market in all of the different denominations to maintain, liquidity in every tier of the Treasury markets. And when you make a decision, as we did, to lengthen the average weighted the weighted average maturities of Treasuries, we did it gradually over a period of time, and we did increase the tenor of Treasury's debt, which gave us the benefit of locking in a lower rate. Now, you wouldn't do it all at once if you were trying to maintain all the different tiers of the market. Sometimes people say, why don't you just shift to a 100-year bond or 50-year bonds? The truth is you need 30-day bonds, you need 60-day, you need 6-month, you need a year, you need 2 years. There's different parts of the market, all of which are the most liquid in the world. I think that the question you're asking of how the yield curve, informs that process.
Does it influence?
Not a lot. Not a lot. You're aware of it. I mean, you follow the data inside just like you follow the data outside. You know it's going to affect your costs. But your primary concern is to make sure that you're on a pathway that's well understood by the markets, because that's what keeps the United States bond market where it is in terms of being the benchmark of stability in bonds. I think that's a huge national asset. It's something that has helped us in good times and bad, and it's something that I hope is protected.
That comes down to the other issue of the U.S. dollar. Is the strong dollar policy over. What do you make of that conversation and how that confusion began, what, 2 years ago, and when that conversation has actually gone right now?
Yeah, I was surprised to see some questioning on that. It certainly has been many decades that people in my position said very similar things about the dollar. You know, I was in office at a time when you couldn't deny that the strong dollar had some headwinds attached to it in terms of selling products overseas. But I always said, if the reason for the strong dollar was that the U.S. economy was stronger than other economies, the challenge was to strengthen other economies, not to drive down the dollar. Now, I think the current kind of fluctuations in the value of the dollar are reflecting some of the kind of chaotic policy as much as the economics. Right. And you have to kind of separate that from where's the core of the U.S. economy.
In terms of the core competency of the U.S. economy, when you look at these trade discussions, do you think those jobs will ever come back to the United States and stay there?
Look, I think the jobs situation in the United States now is, on the one hand, very strong. We have the lowest unemployment rate in a generation. We've created more jobs over the last 9 years than any other period of time. The jobs aren't all the kind of good jobs that we want to have. Now, where the good jobs are going to be, it's not going to be by looking in the rearview mirror at where the economy was in 1950. It's going to be looking ahead to where the economy is going to be in 2050 and 2025. We know that there's a skills gap. You have millions of jobs open and millions of people looking for jobs. It means there's a skills gap. That means we ought to be spending more on education and training and apprenticeship and helping people to break into the economy. Now, instead of the tax cut, I would have put resources behind that. That would have helped to create the jobs of the future. I think you look at infrastructure. The United States had the best infrastructure in the world for half a century. We're on borrowed time now in terms of keeping our investment level where it needs to be. We should have put money into that.
Does it need to be up, the investment level? I mean, the amount of money that's being...
It does. It needs to be up for several reasons. First of all, 50-year-old roads need to be maintained or replaced. Ports that are designed for ships that are smaller than what are currently in use need to be deepened. Airports have to move people and goods efficiently and comfortably. We can't fall behind. You can't. I mean, we have a lot of strength in our built-up infrastructure, but it's not going to be that way in 25 years if we don't start investing more.
Is there a dollar figure you would attach to the infrastructure you need? I mean, that's a fluid concept.
It's fluid.
But what's the basic?
There have been very big numbers about what the shortfall is. We were hoping to put hundreds of billions of dollars to work, but one could justify numbers that start with trillion. And I don't think the large number should stop us from getting started. There should have been a bipartisan agreement to increase infrastructure funding. Frankly, if it had been connected to a smaller tax cut, you would have seen bipartisan support, I think, for something that had a balanced approach. We're now in a fiscal situation where that's much harder, and that's our own doing. You can't blame anyone but our own decision makers for making that choice. I also think that when you look at trade and jobs, the impact of technology and the impact of globalization are often fused. They need to be separated. We can't stop technology. You can stop unfair trading practices, but you're not going to stop the flow of technology. The challenge is not to go back to a time before, but to have the skills for the economy of the future.
Something to think about. Mr.